Okay, sir, we will start the program so that in the meanwhile, people will join. Okay. Sir, shall we start?
Yes, yes.
Okay.
Hi all, happy evening. My name is Siddharth. Today with me, my colleague Sridhar will also take today's session. Today we are going to discuss about NRI taxation. In case you have any questions, please wait. Keep noting it. We have time. We have time. We have kept time at the end so that you can ask us questions and we can answer your questions. So I have with me Sridhar, who had got few questions regarding taxation. Let me take his question first.
Hi all, happy evening. Siddharth, I have a few questions on taxation. So before you're taking, when I say NRI taxation, I have a few questions for you. On what basis income tax is charged and collected for an individual?
Yeah, Sridhar, it is totally based on the residential status of the individual.
Okay, what is residential status? I didn't understand the terms residential status.
So it is the residential status is status of a person for tax purpose, which is determined as per the tax provision of a particular country.
Good, but how can I understand this? Is there any provision of the income tax act which will help me to determine the residential status?
Yes, Sridhar. We have in our Indian income tax law, we have section 6, which explains the residential criteria for residential status.
Great, thanks, Siddharth. I think this was helpful. But is there any basis on which, is it that only residential status is the one on which the taxes are collected, or is there any other basis of collecting the taxes?
No, globally there is a practice, Sridhar, where country tax either based on resident or based on source. So even if you are not a resident of a particular country, the country may tax you on basis of source. Suppose, for example, if you are a non-resident and you have a property in India, so the Indian government will tax you for the rental income which you earn from the property situated in India, irrespective of the fact you are resident or non-resident.
I think income tax seems to be a little complicated. Can you explain to me more? I'm finding it difficult to understand this.
Yes, Sridhar. Let me explain you one by one. So, the taxability under the Income Tax Act, it depends upon the residential status of a person. Residential status broadly can be classified into resident or non-resident. Further, in India, resident individual and HUF can be classified as ordinary resident or not ordinary resident. A scope of the ordinary resident, they are taxed on in global income in India arising during the financial year. So we have a site where we can see which all country taxes on based on the resident or based on citizenship. Mudit is presenting it. Yes, Mudit, you can go a bit down. Yes. So here we can see country of territory, taxes on local income, that is basically source income, taxes on foreign income, that may be in case of a resident or non-resident citizen. So for each country, the criteria is given for which it is taxable, as in for which only local income are taxable, or where resident are taxed on global income, or where even the citizen are taxed on global income, even if they are non-resident. For example, Mudit, you can go down in US, even if you are a non-resident, but if you are a citizen of US, you are taxed on global income. US at the end, possibly. Yeah, United States. So you can see in US, all of them are yes. So even the local source is taxed. If you are resident, then also then the global income is taxed. And if you are non-resident, and you are a citizen of US, then also the global income is taxed in US.
This seems interesting for me. There are a long list of countries where I can see it's based on residence which has been taxed.
Correct.
Yes, of course. I think, as you rightly said, there is also countries which is taxing on source base of taxation. And this is very helpful for all of us to understand what is resident-based taxation, what is source-based taxation. Thanks to that, this was very helpful.
Yeah, we can move it to next
So
slide.
how do we determine residential state? Yeah. We have I have one more question, Siddharth. What is taxation for a resident who earns income from a source outside India? So I'm a resident. For me, what is it taxed? I have certain income which I earn from US. For me, will the income earned by me in US, will it be taxed in India again?
Yes, Sridhar. Since you are a resident in India, your global income will be taxed in India.
Oh,
Doesn't mean that you have to pay tax as in twice. In India, as in every country has double tax avoidance agreement with the other country, where the resident country, in this case India, will provide foreign tax credit in case you are taxed in any other country for any other source. So suppose you are earning interest income from US,
right.
and there is some taxes you have paid in US. So being a resident, an ordinary resident in India, you are liable to pay taxes on global income. So interest income that you have earned in US will again be liable to tax in India, but you will get a benefit that whatever taxes you paid in US, you will get the credit of those taxes by the means of foreign tax credit in India.
Oh, that's a great relief for us. That's a
So
great relief for.
Yeah, technically there is double taxation, but you don't have to pay twice on the same income.
Glad I know that actually there is a double taxation avoidance agreement which will help me to avoid double taxation. So thanks. This was helpful to that.
So similarly, if a non-resident, if he has paid taxes in India, he can also claim tax credit in the country of which he is resident. Suppose Sridhar is a US resident, and being a NRI, and he has some property in India for which he is getting rental income. Now, in those for those rental income, he is required to pay taxes in India.
Right.
Right. Now, being a resident of US, he is required to pay taxes in the global income, which he earns from which he earns globally. So technically, the rental income which he has earned in India will again be taxed in US.
Oh, okay.
Similar provisions are there in US where you can get credit of taxes paid in India since you are resident of US.
Wow, this is very
For the
helpful.
rental income.
Yeah, basically I get leave for whatever taxes paid in other country. That itself is a great relief for me to understand that the taxation is actually not causing me double bill.
Right. Right.
Siddharth, can you help me to understand how do we determine the residential status? Is there any way
Yeah.
how to determine the residential status?
So broadly speaking, residential status for a firm or a company can the firm of a firm or a company can be either resident or non-resident. But for an individual, there are three criteria. It can be ordinary resident, non-ordinary resident, or a non-resident. Since today's topic is more about non-resident individual, we'll focus on residential status of individuals. Next slide. So this chart broadly defines how the residential status of an individual is determined. Don't get so confused looking in this
Siddharth,
chart.
it scared me. So you need to go slow for me to understand this. So you can help me to understand this particular residential status. How do I determine my residential status?
Yeah, yes, sure. So firstly, we'll go from the top one. Stay in India if it is more than or equal to 182 days in a financial year. Then then you are a resident in India. Okay. Once you are a resident in India, we have to determine whether you are an ordinary resident or not ordinary resident. So for which there are two criteria. If both of these criteria satisfies, you will become ordinary resident. If one of the criteria doesn't satisfy, you will become non-ordinary resident. So one of the criteria is you should be resident for at least 2 years out of 10 preceding financial year, and your stay in India should be more than or equal to 730 days in preceding 7 financial year. So the word here used here is preceding financial year. Suppose we are determining residential status for financial year 2021. So we have to look 10 years after, sorry, 10 years before 2021. If in those 10 years, any 2 year you are resident in India, then the first criteria would be satisfied. Second criteria is if out of 7 preceding financial year, if you are residing in India, your stay in India is for more than 730 days, then the second criteria will also satisfy. If both the criteria is satisfied, you are resident and ordinary resident in India. Otherwise, you become ordinary, non-ordinary resident. So first limb we have completed, where if you stay in the current financial year for which you are determining the residential status is exceeding 182 days, and then you become a resident. And for determining ordinary and non-ordinary resident, you have to check if both this criteria, as in resident in India for 2 years out of 10 preceding years, and stay in India for more than 70 days is satisfied. So let us go to next limb, where your stay in current financial year is less than 182 days. So in that case, we have to first look into the thing, your total income from Indian source other than foreign source is exceeding 15 lakh. If that is not exceeding 15 lakh, you will and you are falling within the explanation 1 to 60 section 6.1. We'll look into explanation 1 to section 6 subsection 1 later on. But if you are falling within that criteria, right, then you become a non-resident. If you are not falling within that criteria, then we have to look whether your stay in India for the current financial year for which you are determining residential status is exceeding 60 days, and your stay in past 4 years, preceding 4 years, is exceeding 365 days. If this criteria satisfies, you become a resident in, if both of these criteria satisfy, you become a resident in India. Then again, the same series continues, as in you have to check whether you are ordinary resident or not ordinary resident, right? If your stay is, as in if you not satisfy any of this criteria, you straightforward become a non-resident. Okay. So next thing, let us go if your income is exceeding 15 lakh. So if your income is exceeding 15 lakh and you are Indian citizen, and being an Indian citizen, you are not liable to tax in any other country. So mind you, mind the words, sorry, mind the words. It says if you are not liable to tax in any other country and you are Indian citizen and your income is exceeding 15 lakh, your stay in that particular year is below 182 days. Then also you will become a resident but non-ordinary resident. This is a recent amendment brought through Finance Act 20. So we'll look into it on in subsequent slide. So next limb, if you are Indian citizen or person of Indian origin. So if you are Indian citizen and person of Indian origin, and your income in India is exceeding 15 lakh, and your stay in India for that particular year is less than 182 days, then we have to see whether if you have come uh, and you have come to visit in India or visit in India and your stay in India is for more than 120 days, and you have visited and stayed in India for more than 365 days in preceding 4 years, then you become a resident but non-ordinary resident. Or else, if you don't satisfy both this criteria, you become a non-resident. So, yeah, we can.
Yeah, so that I have a few questions here again.
Yeah.
So basically, when I say falling under explanation 1 to section 6.1, so what is it falling under explanation 1 to section 6.1? That is first question.
Yeah.
And the second question which I have is, when I say comes to India, that means if I'm an Indian citizen or a person of Indian origin, who are these people, Indian citizen or person of Indian origin? So can you please clarify these points?
Yes, Sridhar, we'll clarify. We'll go into next slide. We'll next slide. So when I say Indian citizen means a person who is a citizen of India. And when I say person of Indian origin, means a person who is of Indian origin if his parents or his grandparents are born in undivided India. Okay. Now the explanation 1 to section 6 says if any person who leaves India for the purpose of employment outside India, or he is a member of Indian SIP, then in that case, even if you don't satisfy, sorry, only only in case you are you can be a resident in India if your stay in India is exceeding 182 days in India. And there is one more exemption given when you visit in India,
Right.
and your stay in India is less than 182 days, you are not you are a non-resident. But there is an exception which has been brought in case you are an Indian citizen and person of Indian origin, and your total income is excluding income from foreign sources is more than 15 lakh, then your stay should be less than 128 days to become a non-resident.
So just to understand this better, does it mean that if I have a source of income in India, India sourced income more than 15 lakhs, for me the number of days of stay is not 182, it is 120 days.
Correct.
Surprising for
Correct.
me.
Only in case you visit India, but in case you leave India,
okay.
Then still you have a provision, as in the 182 days continues to.
So when I leave India, it should be only for the purpose of employment or as a member of crew of Indianship. Is that the criteria?
Yes. Yes.
Okay. Thanks, sir. This was helpful. Can you explain me what is India sourced income? What is foreign sourced income? I'm a little confused here. How can I understand what is India sourced income or excluding foreign source income? Can you help me to understand this?
We'll look into it. Next slide. So firstly, we'll look into the reason why the 182 days has been reduced to 120 days. The basic reason is many Indians were using this 182 days criteria. They used to visit India and they used to have substantial income or activity in India. But somehow by staying in India for less than 182 days, they used to avoid the residential status. So due to this, they were becoming non-resident for a longer period of time, even though they have a major source of income from India, and they were not required to declare the global income. So Indian government thought to catch hold this loophole, they've reduced 182 days to 120 days in case you visit India again. Next slide. Previous one.
Siddharth, do you have any illustrations for this? Because I'm unable to understand this. So can you help me explain with examples?
Sure, Sridhar. So this table will give you a broad output as in what is the change that has been brought in the law. So if you stay in during the financial year uh, and you are Indian citizen and person of Indian origin who being outside visits India during the financial year and you stay in immediately preceding 4 year is more than 365 days. So in first case, if your stay in during that particular financial year is less than 120 days, so no need to worry. You become a non-resident even if you have more income more than 15 lakh or less than 15 lakh. That doesn't matter. So until and unless your stay in India is less than 120 to 120 days, there is no criteria. There is no change in the law for those cases. So next case arises where your stay is 120 days or more, but less than 182 days. So in this case, we have to see whether your income from India is more than 15 lakh. So in this case, if your income from India is more than 15 lakh, you become a resident but non-ordinary resident. This has been the change which has been brought into place. And other criteria was if your stay in India is 182 days, then it was obvious as in you become a resident of India. So one thing that we need to take care in this, we need to be very careful is if you become resident due to this criteria, right? As your stay in India is for more than 120 days and your income in India is more than 15 lakh, then you become resident but non-ordinary resident. You don't have to go to that second criteria as in staying in your stay in India being more than 29 days in past 7 years, or and you're being a resident in more than 2 years out of 10 preceding financial year. We don't have to go there. You straightforward become a resident but non-ordinary resident.
This was very helpful, Siddharth. So now I could clearly understand that if my stay in India is more than 120 days, but less than 182 days, I'm still need to be worried, provided my income is more than 15 lakhs. So the amendment which has been brought in place is making me from a non-resident to not ordinary resident. So I think this was very helpful. So this is the one point which I feel all of us should take home or take away for this from the session. Meaning that in case the stay of a person of an Indian origin or an Indian citizen who comes back to India on a visit and stays in India for more than 120 days and he has got India's sourced income more than 15 lakhs, he becomes a resident but not ordinary resident. In earlier scenario, he was a non-resident, but now his residency status will change because of the new amendment. Yes, the amendment has got impact on this particular scenario. All other scenario is almost intact. What was there earlier will continue to be there. The important point which I need to keep here in mind would be to see, am I a person of an Indian origin or an Indian citizen who's coming back to India on a visit? That's a criteria which you need to be remembering from this section. Thanks, Siddharth. This was very helpful. Can you explain further on what are the types of income which is considered, which is not considered, or foreign source income, which should not be considered for me for determining the decrement of impact?
Sure. Next slide. Next. So the new provision is applicable only if your total income other than income from foreign source exceeds 15 lakh in India. So income from foreign source means income which accrue or arises outside India. So except in case where you earn an income from a business or profession set up in India, that is also deemed to be income from Indian source. It doesn't fall within the criteria of income from foreign source. So thus, for computing the threshold for 15 lakh, we have to take into account all the income which accrue or arises in India, deemed to accrue or arises in India, which is received in India, which is deemed to be received in India, and which accrue or arises outside India, but which is derived from a business controlled or business profession setup in India. So
This seems to be a complex maze for me. Can you give me some examples of foreign source income so that we can understand this better?
yes, Sridhar, we'll look into what are some examples of Indian source, and then we'll look into what are the example which are income from foreign source. Next slide. So here are the some example which are included within the threshold of 15 lakh. That implies as in the limit of 15 lakh, that is total income excluding income from foreign source. So dividend or interest income received from a resident in India. So if a domestic company, let us take example TCS, is giving a dividend, then it would fall within the 15. We have to take into account that dividend income while calculating the 15 lakh threshold. Or any non-resident, if he is earning interest income from India, let's say he has a FD in Indian bank account. So any interest that he earns from that FD will be included while calculating the threshold of 15 lakh. So next point is income from business controlled in or profession set up in India. So being a non-resident, if you have any business or profession set up in India, and you earn any income from that business through that business or profession, that would be included within the threshold, as in that would be a part of total income other than foreign source. Next point is capital gain arising from transfer of property situated in India. Next point is capital gain arising from transfer of shares of Indian company. Next point, capital gain arising from transfer of shares of a company which derives its value substantially from property situated in India. So this is a case of indirect transfer. We had Vodafone case, which has gone a long way, through which this provision has arise indirect transfer. So in this case, what happens? Suppose a company, there is a company in US. It has a subsidiary in Singapore, 100% subsidiary in Singapore, and through that subsidiary, US company is investing in India. So let us suppose shares of US company is selling the shares of Singapore subsidiary. In that case, since the Singapore subsidiary is deriving its value from property situated in India or shares situated in India, it would be deemed that such capital gain, such shares are from Indian source. So you are liable, the US company would be liable to pay tax on such such transfer of shares of Singapore subsidiary. Next is rental income from property situated in India. So if you have any property in India and you are earning any rental income from that property, that would be included within this threshold while calculating this threshold.
Oh, this is very clear for me, Siddharth, now. I think for the students here, I think just to understand the facts here, if there is any income, which is India is a source country, right? Those places, this has to be counted for the purpose of 15 lakh. So in case there is any person, if he is a non-resident and receiving income in these natures, dividend from an Indian resident or income from a business of profession controlled in India, or from a capital gains arising from property or shares or rental income from a property situation in India, that case, India becomes a source country. For the purpose of determining the threshold of 15 lakh, I should add up all this and then arrive at the 15 lakh. In case after summing up or adding all this heads of income, I don't get a limit of 15 lakh, then I may be not impacted with the amendment which has happened recently.
So let us look into some example where it would be termed as foreign source and it wouldn't be included while calculating the 15 lakh threshold. So if you are earning any salary and for services rendered outside India, that wouldn't be included within this 15 lakh limit. Next is dividend income arising from overseas sources, interest income arising from overseas sources, capital gain arising on transfer of property situated outside India, rental income from property situated outside India, business income from overseas source having no nexus in India. This implies as in business income from foreign company, from foreign sources where they don't have any business setup or profession in India.
This was very helpful, Siddharth, where we are trying to understand that these are the heads of income which is earned by a non-resident outside India that need not be added to determine the 15 lakh limit. If I have an income of 15 lakh or more after summing up all this, right, then I need not worry about the new amendment. So I should only be worried about my India sourced income, and all this foreign sourced income I need not add to determine the limit of 15 lakhs limit. This was very helpful, Siddharth. Can we have the next slide and see what is there for us to learn?
So one question may arise is whether exempt income should form part of this while calculating the limit of 15 lakh. So when we see the provision as such, it uses the term total income. So when we use total income, it implies total taxable income. So exempt income will not be forming part of the total income in that case. For example, if you are a non-resident and you are earning interest from NRI account that you have opened, that you have in India, or you are earning from foreign currency non-resident deposits that you have made in India. So any interest income from earned from these two sources are exempt in India. So this won't be included. This will not be included, even though they are accrue arising in India. They won't be included while calculating the 15 lakh limit.
This was very helpful, Siddharth. So basically, you are trying to tell us, don't consider foreign sourced income, don't consider exempt income for the purpose of determining the 15 lakh limit. Consider only those taxable income which are India sourced, and ensure that if that amount exceeds 15 lakh, only then you're supposed to go to the new amendment. Else, the old provision of 182 days will stands good. Is my understanding correct, Siddharth?
Yes.
Okay, thanks, Siddharth.
Next. Let us look into.
I have one friend who is actually told me that the residency status is also determined as per tax treaty. Is he correct? What he said?
Yes, Sridhar. There are in every DTAA that is totally based on residential status of a person. So
Okay.
if you are a resident of a country, then only you can claim DTAA benefit. So each DTAA defines residential status.
Oh, then I need to understand the definition of residential status even as per DTAA as well?
Yes, yes.
Oh, this is interesting. Can you please explain?
Yeah. We'll look into an example where we have taken Article 4 of India UAE DTAA. So it says, for the purpose of this agreement, the term residence of a contracting state. So whenever you read a DTAA, right, you will see a word contracting state. As in, it uses the word contracting state instead of country or any other thing. It uses the word contracting state. So for the purpose of this agreement, the term resident of a contracting state means, in case of India, any person under the law of India who is liable to tax therein by reason of his domicile, residence, place of management, or any other criteria of similar nature. This term, however, doesn't include a person who is liable to tax in India in respect of only income that is sourced out of India. Implies if you are liable to tax in India because of your for in case of individual case, because of your stay in India for a particular for some particular days or something, and then you are resident of India for the purpose of DTAA. But if you are liable to tax in India just because you have a source of income from India, you are not a resident in that case as per DTAA. So, for example, Sridhar is a US. For example, let us assume Sridhar is a US. He is staying in US, and his stay in India is nil for a particular year. But he has some property in India which he has let it out. So just because he earns just because he earns rental income from India and he's liable to pay tax in India doesn't mean he become a resident in India. For being a resident in India as per DTAA, he has to be liable to tax based on number of days or similar criteria. So only if he is stay in India for exceeds 182 days or 120 days as the case may be, then he will be termed as resident in India as per DTAA. So this was for a resident in case of India. In case of UAE, UAE doesn't have tax for individuals. So here it uses the word, there is no tax for individuals.
Oh.
So an individual.
Lot of scope for tax planning in that in UAE.
Yes, Sridhar.
Oh.
But we'll learn subsequently. Indian government has also taken out that exemption from us.
Oh, is it? So I'll be glad to know that. So please continue.
Yeah. So in case you are a citizen, in case of UAE, any individual who is present in UAE for a period exceeding 183 days in a calendar year shall be considered as a resident in UAE. And for a company purpose, if that company is incorporated in UAE or it is managed or controlled wholly from UAE, in that case, that company becomes resident of UAE. So let us look into what is the impact of the new amendment that may happen. In India, UAE DTAA considers an individual to be a resident if such individual is liable to tax in India by reason of his resident in India as per Income Tax Act. Thus, the individual who under the Act pursuant to this amendment becomes a resident in India, he will become okay. So can we move to first slide? We can. So resident of a contracting state, either a contracting state. In case of India, UAE, DTAA, it may be India or it may be UAE. So if a contracting state, when I say resident of a contracting state, so in case of India, so resident of India would be a person who under the law is liable to tax therein by reason of his domicile, residence or place of management. So if any person by reason of his residence or place of management or domicile, he becomes a resident in India as per Indian tax law, then he would be determined as resident of India for the purpose of this DTAA, India UAE DTAA. Uh, yeah. Gunasekar, I think if you have any doubt, you can ask me. Yeah. Okay, we'll go to next slide. So, if suppose by way of due to this amendment, an individual becomes a resident in India because his stay in India is more than 120 days, then he will become a resident as per DTAA as well. Now, let us suppose his stay in that particular year in UAE is exceeding 183 days. Also, that may be a case, as in if we add 183 days and 120 days, that is quite possible, as in a person may be a resident of both the countries. He may be a resident of, he will be a resident since he is exceeding 120 days in India, and he can be a resident of UAE since his stay in UAE is more than 183 days. In that case, we have to go to Tribecker rule. So, what is Tribecker rule? We'll look into.
Basically, Siddharth, I have a doubt here.
Yes.
I am an individual. If I'm a person who was in UAE for more than 183 days and comes to India for a stay, right? In that case, you're telling I could be a dual resident. I could be resident in India because of the new residential status amendment. I have my income exceeding 15 lakhs, India source income exceeding 15 lakhs, and my stay in India is more than 120 days. Does it mean that I become a resident of both the countries?
Yes, Sridhar, you become a resident.
It's quite difficult for me to deal. I have to pay taxes in both the countries. How is it possible?
Yes, Sridhar, but there are Tribecker rules where the DTAA help us to determine, as in you become a resident of which country. In case you are resident of both the countries, as per DTAA, then there are certain criteria based on which you can determine as per DTAA your country, you are resident of which country. So, in case of India UAE, let us look into the Tribecker rule. So, while applying Tribecker rule, right, it is similar to, as in we have to go one by one. As in, first we have to look into permanent home. If permanent home doesn't satisfy, we have to go to point number 2. If point number 2 is unable to determine our residency status, we will go to point number 3. If point number 3 is not is not helping us, we will go to point number 4. As in, it would be we have to go in order. We can't go directly to 5th point and say as per 5th point, I am becoming a resident of India or I am becoming a resident of UAE. So that as per Tribecker, I am resident of that particular country. No, you have to go series wise, as in one after another. If one doesn't satisfy, you have to go to another. If you are determined by one point, you will stop there. You don't have to go further.
So that if we want to understand correctly, I am a resident of UAE because my number of days of stay in UAE is more than 183 days. That means I'm also residing in India for more than 120 days. I become a dual resident. So whichever country I have a permanent home, in that country I'll become a resident. That is what you mean to say?
Yes, Sridhar. So first criteria.
First condition, do I need to look for second condition?
So if you satisfy first criteria, suppose you have a permanent home in UAE,
right,
then you become a resident of UAE in that case. You don't have to come to second point.
In case I have house in both the countries, I have one residence in UAE, one residence in India.
So the first point won't be relevant for us. We are unable to determine your permanent home in a particular country. So, or else there can be also a case where you don't have a permanent home in both the countries, right? In that case, we will go to second point, which is personal and economic relationship. So, in whichever country you have more personal and economic relationship. Personal maybe of from family point of view, and economic maybe from earning point of view. So you have to look into that countries, as in we have to look into that scenario. We have to say, suppose I have my family with me in UAE, and I'm earning from UAE. I have nothing here in India with me. So my personal and economic relationship in that case would be from is in UAE, not in India. Then I become a resident of UAE in that case.
Oh, so does it mean that I am be more benefited if I become a resident of UAE in this case? So my family and my major source of income, if it's in UAE, then I need not be a resident in India for taxation purposes.
Correct. So
Okay.
there can be a case where you don't have a personal or economic relationship in both the countries.
Okay.
Let us assume, or you may have as in both the countries. Suppose your family is staying in India, but you are earning income in UAE, or else you are or whenever you travel, you take your family with you, and you are earning income from both the countries. In that case, second point, we are unable to determine in which country you have personal and economic relationship more, right? In that case, we have to go to next limb, as in which says habitual adopt, where your frequency or regularity of stay is more. That would determine your residential status. Suppose you are frequently visiting, as in your stay in UAE is more, or your stay in you are regularly staying in India, in UAE. In that case, you become a resident of UAE by the third limb, habitual adopt.
This will help us in that. Is there any other criteria which I need to looking forward for?
Yes, in case even due to this criteria, we are unable to determine, as in, if in both the countries you have frequent duration of stay, and you are regularly staying either you are staying in India or you are staying in UAE. So you are regularly staying in a particular country. You are unable to determine your uh, habitual adopt. Then you have to look into nationality. So if you are national of UAE or India, then based on nationality will determine the residential status that particular country.
So I'll be very happy if I become like UAE national, because I know the taxation in UAE is very less, or there's no taxation for individuals. So this was very helpful information. I will be very happy if I become an UAE national to avoid taxation in India. Is there any way, even if I'm not able to determine my nationality, can I say I can be an Indian national? I can say that UAE also I can get a nationality there and I have a situation there. How do I do it in that circumstances?
Yes, Sridhar. In that case, there would be something like backward Lewis. Competent authority, the empires would decide you are
There's a
resident of
third
which
empire
country.
here who's helping us to determine.
Yes, in that case, it similar to in cricket, as in the empire would decide the country of which, sorry, in the team which we will be winning the match. Similarly, in this case, the tax authority of both the countries will come together and determine your residential status.
Oh, this is actually amazing. I think I should be very careful and ensure that all these aspects are taken into consideration before my residential status is determined.
Akshit, possibly you can ask now or later also will be fine. Sorry, Arijit.
Sir, my question is that if a person who is resident in India, working in an MNC, and he's actually the organization which is registered under Companies Act in India, and the main like the parents arm is from like a different country, a foreign country. So now the company he is working, the immense Indian company, he got some sweat equity shares, and in that case, the share is allotted of the parent company, which is registered in a different country, in a stock exchange. So in this case, how we are going to treat this? Because what I have seen that the organization which is in India, they have treated as perquisites, and they doesn't have disclosed as it as a foreign income for the employee. So what is going to be the tax statement, and what is going, like, how we should disclose this income?
Okay. Arijit, in this case, right, he is earning, if I'm correct, he is getting shares of a foreign company, parent company,
Yes.
right? Yeah. So in this case, whatever is the difference between exercise and fair market value, as on the date of exercise, it would be taxed at salary income in India. So any, as in, suppose the fair market value on the date of exercise is 10, and exercise price is 5 rupees. Let us suppose exercise price is 4 rupees. Then the differential between fair market value and the exercise price, that is 6 rupees, which the employee has got benefit, it would be taxable as salary in India. The Indian company would deduct TDS. Normally, in this case, Indian company would deduct TDS, and uh, as under section 192, and it would deposit, and you have to show it as salary income while filing income tax. But one point we need to be careful in this case is we have to also disclose this as in foreign asset schedule while filing ITR. Normally, this point is being ignored while filing ITR. Whenever you get a shares of foreign company through ESOP, you have to disclose it in foreign asset schedule while filing income tax return.
Yeah, just to add on, Arijit, in terms of this, section 912 is very clear, telling that for a person who is providing services for a company in India, and his services actually to an Indian company, it is very clear that the taxation is with the Indian employer. So any money or any allowance, any perquisite he gets in lieu of the employment with the Indian employer will be subjected to tax in India. That is the reason why withholding of taxes will apply here. In case there is any taxes which has been paid outside India in view of this stock option, that can be claimed as a foreign tax credit, provided there are certain sufficient documents for that particular tax payout.
And also there is a this question is related to this the question I have asked already. In the form 16, they are showing it as stock option allotted by the employer being an eligible startup referred to in section 80 ISC.
So here, for the purpose of startup, this should be startup as per the provisions of Income Tax Act. Unless it satisfies the definition of startup as per Income Tax Act, this perquisite should have been taxed. So you can go back, check with the employer, tell him that are the shares issued of an eligible startup in India. Only if the eligible startups in India, the exemption is given, or else this exemption is not given. So the perquisite will be taxable in this case. Arijit, I got your question in detail. In case I can share my email ID because this query has got further iterations. We can discuss or deliberate at the end also, this particular point. It is a very interesting question. Okay. Just to continue with the other aspect, we will continue with the other aspect. Is that fine?
Okay.
So that over to you.
Yeah. So we have looked into the tiebaker rule. We'll go to subsequent slide now. This is India-Singapore DTAA, where there are similar provisions to determine the residential status if you become resident of both the countries. We can go to next slide. So let us look into the impact of the amendment that has been made in section 6. What would it impact? Next slide. So earlier, if you were a non-resident, now due to this amendment, you become resident but non-resident. non-ordinary resident. Now, you would be considered as a resident for the purpose of all exemption, deduction, tax rate, availability, TDS applicability, etc. Next. So here is the impact of increase in the scope of total income. If you are becoming a resident but non-ordinary resident, you have to also include in your total income one more income, that is income that accrue or arises outside India, but that is derived from a business controlled in or profession set up in India. So let us suppose you have a business in India or a profession in India, but you are earning income through that business profession. You are earning income from outside India. In that case, that will be included in your total income, being a resident and non-ordinary resident. If you are non-resident, that won't be included in your income. But since due to this amendment, you become a resident and non-ordinary resident, that income will be included in your total income. Now,
does it mean that, Siddharth, I should be only worrying about one head, even if you become a resident, not a resident but not ordinary resident because of the new amendment? I should be only thinking about income which accrues or rise to me through a business controller setup, which is being a profession setup in India. That is what I need to be careful about.
Yes, Sridhar. The only, as in from the total income point of view, only this is the change factor.
So my income will be added to this particular extent of income which I'm receiving through this profession or a business which is set up in India.
Right.
Thank you.
Next slide. So there are certain concessions that were available to non-resident in terms of rate, which were given in section 115 or in 115 AC. For example, in case of dividend, it is as per 115. If you are a non-resident, you are able to pay 20% straight 20% tax, and you are not liable to pay as per slab rate. Again, as in for interest income, there are earned from government or any other entity. Yeah, there was 20% concessional rate which was provided. There were few more concession in terms of infrastructure debt fund or interest earned from an Indian company in rupee denomination fund or unit of business trust. The rate was 5%, which was prescribed for non-resident. That will not be available to you since you become a resident and non-ordinary resident due to the amendment that has been brought in Finance Act 20. Similarly, there were concessional rate for even royalty and FTS, which was at 10%, which was available to non-resident. So since you become a non-ordinary and not ordinary resident, this concessional rate is not available to you.
I was only thinking, Siddharth, I would be only thinking about the additional income from business or setup or professional setup controlled in India. I was quite surprised to see that my rate of tax, which was earlier 20%, now becomes 30%.
Right, Sridhar. In
5%. Now I have to pay 30% plus surcharge and cess. So my tax rate in India is quite high now.
Correct, Sridhar.
So I should be worried. It's not that only my income or business profession set up in India that will trigger taxation, but my rate of tax also is undergone change because of this new amendment. Wow. I think income tax department is very smart to tax me for these transactions.
Next slide. So pursuant to the amendment, individual who was qualifying as non-resident now will become a non-resident. Normally, as in when a non-resident moves to India, right? He becomes RNOR for 1 year at least, because the criteria of becoming ordinary resident, that is becoming that is out of 10 years, you are resident for 2 years, and your stay in India is more than 30 days or more in past preceding 7 years. That criteria gets satisfied, and that criteria doesn't get satisfied, and you become at least RNOR for 1 year. In that case, uh, for moving back to India for permanently. Now, if due to this amendment, since you are resident for even for preceding financial year, that benefit of exempt, the benefit of being resident and non-ordinary resident for moving back to India for 1 year is not available to you now. And now the global income will be taxable from the year one. From the year one when you move back to India permanently. So, Sridhar, this also we need to be careful. As in, if a person who becomes a resident and not ordinary resident to this amendment, if he moves back to India for permanently, earlier since he was non-resident for a long, as in for the previous preceding financial year, he was not satisfying that criteria to become an ordinary resident. Now that criteria is being satisfied since he is a resident in all the previous financial years. So in the first year itself, he becomes an ordinary resident, and he is required to pay in income tax on his global income.
I think I should be really thinking about this. I should be very careful in terms of planning the residential status. Earlier, there was 183 days flat time available for me to plan taxation. But now, looking at this kind of amendments, I feel my stay in India should not be more than 120 days or 119 days. I should restrict to 119 days. Else, not only that my tax rates are higher, my income, which is connected with business or profession setup in India, goes up. I become a resident as soon as I come to India. That looks to be a little difficult if I'm going with the old tax planning. The old tax planning which I had was stay in India should not be more than 182 days. Is no more going to work now. This was very helpful, Siddharth. I think all of the students here would also appreciate the fact telling that the earlier tax planning of 182 days is no more actually available for a person who has left India and comes back to India on a visit.
Yes. Next slide. So just for a recap, once an individual qualifies as non-ordinary resident, firstly his total income will increase because one more limb will be added. That is, if he is earning from outside India through business control or business or profession set up in India. Next, he will lose certain exemptions or and concessional rates that were available to him. One point that we need to be careful here is the interest on NRI account or FCNR account. It will not be impacted. You will still be getting exemption for interest from NRI account and FCNR account, FCNR deposits, even though you become a resident and non-ordinary resident, because both these deposits, the exemption are given based on the FEMA guidelines. Since if you are non-resident as per FEMA, you are exempt from any interest that you earn from NRE account, non-resident external account, or FCNR account, foreign currency non-resident deposits that you earn. If you earn any interest income from these two accounts, and you are a non-resident as per FEMA regulation, then you still can claim that exemption even though you become a non-ordinary resident as per Income Tax Act. Next point is you will lose certain concession that were available in DTAA, as in due to that due to becoming non-ordinary resident in India. Next slide. So, takeaway from the amendment which we have seen is while considering the residential status, we need to be careful that your stay in India should be less than 120 days, and your income source from income that is from Indian source should not exceed 15 lakh. If both of this criteria uh, doesn't satisfy, you become a resident and resident, but not ordinary resident in India.
I think this was very clear, Siddharth. I think the students here would appreciate the fact that 182 days is no more a criteria now. So that earlier the number of days of stay was 181, just to avoid the residential status in India. Now that threshold of 181 has come down to 119 days. That is an important point to note. And the other important point to note is it's not that only one criteria I should be worried about. I should also ensure that income of the India sourced income does not exceed 15 lakhs. So in case I have one question here, so that in case I ensure that my stay in India is 119 days and my income in India, my India sourced income in India is, say, for example, 1 crore, will I be liable for taxation as a non-ordinary resident?
No, Sridhar, as long as any of these two criteria, that is staying in India for less than 120 days, or your income source in India is not exceeding 15 lakh. If any of these criteria satisfy, you do not qualify as not ordinary resident. You become a non-resident in that.
So if I want to understand once again, my stay in India is not less than 120 days is one criteria.
Right.
So if I cross that criteria of 120 days, then still I can be considered as non-resident provided my income does not exceed or likely to exceed 15 lakhs. My India sourced income does not exceed 15 lakhs. If my India sourced income is 14 lakhs instead of 15 lakhs, even then my stay in India in this case could be more than 180 days. I still call it to be a non-resident. Am I right?
Yes, Sridhar. And one more thing that we need to be careful is this is applicable only when the Indian citizen visits India. It doesn't apply when Indian citizen goes outside India.
Wow, I think the students will appreciate the fact that this is applicable. This new amendment is applicable only for those individuals who have gone outside India for various reasons, but coming back to India for a stay or coming back to India for a family visit, and their stay exceeds 120 days. That is where this new amendment gets impacted. Siddharth, you were mentioning about the exempt income. Can you please explain it further for the NRI interest?
Yes, Sridhar. So let's move forward. Yeah. Next point. Next slide. So as I mentioned earlier, in case of interest from NRI account, the exemption is still available pursuant to this amendment also. As in, even if you become non-ordinary resident, still interest from NRI account would be exempt in your case, since the exemption that is provided in section 10, clause 14, 2, which provides exemption for interest from NRI account based on your residential status as per FEMA. So, as per FEMA, still the residential state to determine the residential status, the criteria is 183 days. It has not changed. It has not become 120 days. So until and unless your stay in India is less than 183 days, you still become a non-resident as per FEMA. And the exemption for non-resident NRE account, interest from NRE account is available to you, even though you become an ordinary resident as per the amendment that has been brought in Income Tax Act.
Wow, Siddharth, this was very helpful, Siddharth. I think it opened our eyes, telling that yes, because of this amendment, there are a lot of income which gets impacted, tax rates get impacted, certain exemptions which was there in my DTAA was lost. But at least we have interest earned on NRE account, which is still protected with this particular provision. So
Yes.
tomorrow, income tax may bring out the amendment for this, or they may ask FEMA to make an amendment to this. But luckily, they have not done any amendment. So at least the interest earned on NRE account is still exempt from taxation.
So next slide, similar provision is applicable for foreign currency non-resident deposits. Same thing applies here also. Here also the exemption is based on non-resident criteria as per FEMA. So until and unless you are non-resident as per until you are non-resident as per FEMA, you will get this exemption. Once you become a resident as per FEMA, you will not be able to claim this exemption.
Right.
Next slide.
Can you explain further on dividend income, Siddharth? For dividend income, what is the exemption last? I want to hear what is the effectively tax I need to pay if I become a resident but not ordinary resident because of this new amendment. What is the additional tax liability for me for dividend income? I understood that for NRE account, there is no impact because the resident status for FEMA purpose is different. But for dividend income, can you help us and understand how is it that it's going to impact my dividend income, which I earned from Indian shares?
Sure, Sridhar. So dividend income, as per we know that dividend distribution tax has been abolished. Now the dividend income is taxable in the hands of shareholders. As per income tax, it is taxable in case of non-resident. It is taxable at the rate 20% plus applicable surcharge and cess. But if you become a resident, then it will be applicable as per your slab rate. So in case, in this case, since your income is exceeding 15 lakh to become a non-ordinary resident, your dividend income will be liable to tax at the rate 30% plus applicable surcharge and cess. So earlier, when you were non-resident, you were paying only 20% plus applicable surcharge. Now, being a non-ordinary resident, you are liable to pay 30%. So even there are certain DTAAs which provides lower rate than income tax act. So one thing while applying tax rates for non-resident, we have to see both DTAA and Indian Income Tax Act. So whichever is beneficial for us, we have to take those rates. So let us suppose in India UAE DTAA, the rate prescribed is 10%, whereas for non-resident, for dividend income, it is prescribed 10% rate. But since in India it is 20% as per Income Tax Act, now we have to see we have to evaluate as in which is beneficial. Obviously 10% is beneficial, so the 10% which is beneficial to us will apply as per DTAA. So even there is 5% for in some country, example India, Hong Kong, even India, Slovenia has got 5% rate. So in those cases, the exemption which was available as in the concessional rate of 5% which was available to a non-resident will now be not available due to this amendment because he has become non-ordinary resident. And he may have to pay tax possibly up to that may go as high as 35.88%.
I think this is very important point, which I think students should make note of it. This is an example of understanding in case the new amendment is in place, the new amendment which is in place, and the number of days of stay of an individual exceeds 120 days. He must come back to India for staying in India for more than 120 days. His income exceeds 15 lakh. That means the benefits what were available to him being a non-resident earlier is getting lost. So the tax rates are higher. This is an example where the tax rate could be as low as 5%, but because of this new amendment, the tax rates have gone up to 35%, or it can be more than that. So it is little important for each one of you to make a note. New amendment is very important to be understanding the repercussion of the new amendment which has been placed. This is also not only the point of view of practice, but also point of view of exams also. There will be a lot of questions on this particular aspect. Just ensure you keep noting of these points. Very important.
We'll go to next slide. So Sridhar, as I was mentioning, there are cases where individual, what he used to do is he used to shift from one country to another just to avoid being a resident of any country. So now
you're trying to say that if a person is not a resident of any country,
correct.
What will be what are the basis on which I'll determine his residency status? This is very helpful, Siddharth. I know one of my friend who travels country to country to ensure he doesn't pay taxes in any country. So he's a person of an Indian origin. So I need to see how is he getting taxed because of this new amendment.
Right. So as in many such individuals were doing as in traveling from one country to another country, and they used to avoid to become a resident of a particular country so that they don't have to pay global tax in a particular country. So Indian government has brought an amendment where they have said if you are an Indian citizen and you are not liable to pay tax in any country due to the reason of your domicile or residency status, then you become a resident of India for the purpose of Income Tax Act. So one more criteria that needs to be satisfied is here also the limit of 15 lakhs should cross. So in case your income is exceeding 15 lakh other than from foreign source, and you are not liable to tax in any country by reason of domicile or residence, then being an Indian resident, you are liable, and being an Indian resident, you will be treated as resident of India for income tax purpose. So even in this case, as in if he become resident due to this criteria, then he will be treated as non-ordinary resident. He will not be treated as ordinary resident. And the expression which is used here, income from foreign source, is similar, which we have explained earlier.
This is very clear, Siddharth. I think in terms of the clarity, if students want to understand better about this, a person who is traveling from one country to other country just to ensure that he doesn't pay tax in India, and he's a person of an Indian, he's a citizen of India who's traveling for this particular country by country to ensure that he doesn't pay taxes in anywhere in the globe. Now, the department is saying, if you're a person or a citizen of India, they say, hey, look, you're a person of Indian citizen, you should pay tax in India, provided you have your India source income exceeding 50 lakhs.
Yes, Shreya. Next slide. So again, as an individual being a citizen in India, having his total income exceeding from other than from foreign source exceeding 15 lakh during any year, shall be deemed to be resident of India if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So such deemed resident could be deemed as non-ordinary resident for the purpose of Income Tax Act. So basic reason that was provided while bringing this amendment was, I will just read that sentence which was given in memorandum. The issue of stateless person has been bothering the tax world for quite some time. It is entirely possible for an individual to arrange his affairs such a person that he is not liable to tax in any country or jurisdiction during a year. This arrangement is typically employed by high net worth individuals to avoid paying taxes in any country on income they earn. Tax law should not encourage such situation where a person is not liable to tax in any country. So there were situations where an individual would plan his calendar in such a way that he used to move from one country to another country just to avoid being a resident of any particular country. So due to this amendment, an Indian citizen, if he is doing such activity and he is earning more than 15 lakh from Indian source, then he will be deemed as resident in India. Only as in one point that we need to be careful is he will become as resident and non-ordinary resident. He will not become ordinary resident if he become resident due to this reason.
So I should catch out of a friend who is actually going country by country and explain to him about this, telling that he'll be liable to pay tax in India because he's an Indian citizen. This is very helpful, Siddharth. I think with the students, will be able to appreciate the tax planning which was done earlier, where an individual was staying outside India for a limited period of time to ensure that he doesn't become a resident in India and pay high taxes. Now, those people are also on the radar. They need to pay taxes in India, provided their India sourced income has already exceeded 15 lakhs.
Yes. Next slide. So the provision to be invoked that individual shall be liable to pay tax by if he is not liable to pay tax by reason of his resident or domicile in any country, then individuals should not qualify as resident of a country and consequently not liable to pay tax in any country. It is a settled law that deeming fiction should be constituted strictly and within the parameter of purpose parameter for the purpose for which it is created. So this amendment would not impact NRI situated outside India if they qualify to become a resident of that particular country under the tax law and DTAA. So not subjected to tax in the local laws of that country. So if you become a resident of particular country by the tax through the as in under the tax law or as per DTAA, then this amendment will not impact you, even though that if there is no tax in that particular country. So though UAE do not levy personal tax, however, if individual qualify as tax resident of UAE under DTAA by residing in UAE for more than 182 days, then such individuals should not be considered as deemed resident under the provision of Income Tax Act. So the impact of this amendment should be only on such individual who is not liable to tax in any country by not qualifying as a resident of any country. Slide. So key takeaway from this amendment is, if you are an Indian citizen and your income from Indian source is exceeding 15 lakh and you are not a resident of any country by reason of domicile or stay in that country, then you become deemed resident in India, and you will be treated as a non-ordinary resident in this case. So in order to avoid this situation, either you should have income less than 15 lakh from Indian source, or you should become a resident of any other country.
Siddharth, just to go back to the previous slide, one important point which I would like to understand here is the number of days of criteria 120 days is not reflecting here. Means the number of days of stay of that particular person in India is not being a criteria here. Am I right?
Correct, Shikhar. As in, even if your stay in India in this case is 0, and being an Indian citizen, you would be you will be deemed as a resident in this through this amendment.
Right. Which the India student should make note of it, telling that for a person who is stateless, for him, the number of days of stay in India will not matter as long as he's an Indian citizen, whichever country he stays, right? He will be subject to tax in India, provided his India sourced income, what we discussed earlier, is exceeding 15 lakhs, right? That is one point which you need to keep in mind. In case he is having income more than 15 lakhs, but he qualifies to be a resident of some other country by way of his taxation, then the stateless person taxation will not get attracted. Mean to say, just to repeat once again, if his income from India source income exceeds 15 lakhs, but he'll ensure that he becomes a resident of some other country for the purpose of payment of tax or any other reason, he will not be covered under this particular provisions. Hope this is clear to all of you.
Yeah. We'll go to next slide. We'll talk about some special exemptions which are available to non-resident individual in India. Next slide. Yes. So when a non-resident individual, NRI, a non-resident Indian, invest in certain Indian assets, he will be liable to tax at 20% straight, and there would be only, as in, if TDS has been deducted at the rate 20%, then he would not be required to file income tax return. So such investment which qualifies for such special treatment are income derived from following Indian assets acquired in foreign currencies. First, shares in public or private Indian company, debenture issued by public listed Indian company, not private one, deposit in bank and public companies, any security of central government, any other asset of central government as specified for the purpose in the gazette, official gazette. Next slide. So for long-term capital gain made from sale of transfer of these foreign assets, there is no benefit of indexation available and no deduction shall be available under Section 80, but you can avail an exemption on profit on such profit from long-term capital gain under Section 115F when profit is reinvested back to shares in Indian company or debentures of a public company or deposit with bank and public companies or central government securities or national savings certificates. So if you are falling within, as in you are earning long-term capital gain from which you have invested through foreign currencies, and you have invested back the sale proceeds in this assets, that is shares in India, shares in Indian company or debentures in Indian public company or central government securities or national savings certificates, then there will be there are certain benefits that is available to you. You can claim exemption under Section 115F. So there are certain conditions that has been laid down. In case capital gain is exempt proportionately if the cost of new asset is less than net consideration. And remember, if new asset purchase is transferred or sold back within 3 years, then the profit exempted will be added back to your income in the year of sale or transfer. So this asset which you have purchased back for claiming the exemption, you have to hold them at least for 3 years. The benefit above made available to NRI even when he becomes a resident until such asset is converted to money and upon submission of declaration for the application of special provision to assessing officer by the NRI. Suppose an NRI who has invested in this asset and now he has become a, a resident uh, by coming back to India. So still he can claim exemption under this section. If he submits, there are certain applications that needs to be submitted to AO for claiming such exemption, even if after you become a resident in India. So the NRI may opt out of this provision, and in case the income will be charged under normal provision as per income tax act. So this is an optional provision available to NRI. He can even opt out of this special provision, and he can be liable to tax as per normal usual provision of income tax act.
This was helpful. So that I think a lot of benefits for non-resident, especially with respect to this thing, non-resident will be having little lesser impact on the taxation because they don't get indexation benefit, and then this would be an alternative for them as an opportunity to reduce the tax liability in India. So then I've heard it from a friend telling that for a non-resident, there are certain limitations of claiming deductions. So for a deduction which we claimed at Chapter 6A, especially ATC, ATDA deductions, I've heard it that there are some limitations for a non-resident. Can you please explain how the deductions can be claimed by a non-resident? Because I understood that India's sourced income is taxed in his hand. Against that, I want to claim certain deductions. What deductions are allowed? What deductions are not allowed? Can give us some clarity about it. That will be helpful.
Sure, Sridhar. We'll look into the exemption which are available to non-resident individual from Indian source income. So next slide. Yes, these are example of certain deductions which are available to non-resident individual as well. So a non-resident, he can claim deduction under section 80C by having a life insurance through life insurance premium payments. He can get this exemption either making payment for premium for himself or his spouse or his children. The premium, one thing we need to be careful is premium should be less than 10% of sum assured. Next exemption that is available to NRI is children tuition fee. So tuition fee paid to any school, college, university, or educational institute situated in India for the purpose of full-time education of any two children is available to be claimed as deduction under ATC for NRI. Next thing is principal repayments of loan for purpose of house property. So deduction is allowed for repayment of loan taken for buying or construction of residential house. Also allowed deductions are stamp duty, registration fee. For if he has taken loan for this payment of stamp duty, registration fee, or other expenses, then such while paying back the repayment of principal for repayment of principal for the loan, he will get deduction under ATC. Next is unit link insurance plans. Unit link insurance plans, if you invest in such insurance plan given by LIC or other 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 insurance company, you will can claim exemption under ATC. Next are equity equity linked savings scheme. You can also claim through investment in equity linked savings scheme. Next. So other deductions that are available apart from ETC are deduction of interest income from house property. Okay. Deduction under Section 80D for health insurance premium. Deduction under Section 80E, which is for payment of education loan. Deduction under 80G for donation that is being made. Deduction under 80 DTAA, that is for saving interest up to 10,000 you can claim. One thing we need to be careful in case of non-resident is TTB is not applicable for non-resident. As a non-resident, even his age is more than 60, he can't be called as senior citizen, because senior citizen, super senior citizen is only available for resident in India. It is not available for non-resident in India. So Sridhar, I think I have cleared you about the deductions that are available for individual.
So I have one question here, Siddharth. In terms of 80E deduction, when I say 80E, education loan taken, interest paid on education loan, is it that the education can be taken for abroad or is it only for Indian?
It can be from both the as in education from any place can be taken, but that university should be recognized by Indian.
India. That means even if I have a relative who is sending his son abroad and he borrows a loan, he will still be entitled to claim a deduction, interest paid. He'll be entitled to claim deduction the 80E, provided the institution is recognized by the Indian authorities. Right. This was, I think, very helpful. I think in terms of deduction which is not allowed is something I need little clarity, so that if you can throw some light where I'm not able to claim deduction for a non-resident. Because in ATC, I always feel telling that 1,50,000 is standardly allowed for a non-resident also. So what are the things which I should be careful while filling the income tax returns of a non-resident? What are deductions is not allowed to be claimed under ATC?
So certain deductions that are not available for non-resident under ATC. Sorry, just a second. My battery has, the laptop battery has gone low. Just a second, I will plug in.
Yeah. So basically here, can you go back to the previous slide? Yeah. Can you go back to the previous slide, please? Yes. So there are certain deductions which is not allowed to be claimed by NRI. These are including investments in public provident fund, which is not allowed for an NRI. So you know that there is a PPF account which a resident can open and ensure that he invests up to 1,50,000 per annum. That's the maximum amount. Minimum amount for investment in PPF is 1,000 rupees. So that's how PPF accounts are operated. But for a non-resident, they are not allowed to open a PPF account. This is an important point. That is the reason why deductions are not given to a non-resident if he is investing in a PPF. That is one point which you should keep in mind. The other important deduction which is not allowed to a non-resident is National Savings Scheme Certificate. These are known as NSC certificate, where there is actually a deposit with the bank which has been kept as NSC scheme or post office, where whatever investment they make in NSC will be allowed to be claimed as a deduction up to a limit of 1,50,000. Similarly, the post office deposit, term deposit of 5 years, where they had option of investing in with the post office, is available for a resident, not for a non-resident. They say these are the benefit which we are accruing or which we are providing to Indian person who are Indian citizen or an Indian resident. This will not be given for a person who is a non-resident. So here NRI means person who is a non-resident, which is what we are referring to. The other important point which we should be keeping in mind is for a senior citizen, there is a deduction called 80 TTB. up to 50,000, which is deduction given for a normal resident who is ordinary resident in India. For a person who is a non-resident, this deduction will not be provided if the person who is a non-resident is also a senior citizen. In that circumstance as well, he will be only entitled to 10,000 deduction, up to maximum 10,000 deduction for the interest earned by him on the savings bank account only. So any interest earned by him on a fixed deposit, even if he is a senior citizen and is a non-resident, he will not be entitled to claim this deduction under ATC or ATTDB. ATTDB is one section which is talking about deduction given to a senior citizen for interest earned on time deposit or term deposit or on savings bank, totally fixed of 50,000. He will not be entitled. Non-resident will not be entitled.
So similarly, as in the exemption limit which is available for senior citizen, the higher slab rate which is available for senior citizen, super senior citizen, that is not available to non-resident, since the criteria of senior citizen and super senior citizen is based on residential status of he should be a resident, or he or she should be a resident in India to become super senior or senior citizen.
Right. So for claiming the basic exemption limit also, if he is a non-resident, then they are not entitled for such slab rate benefit which is given for a normal citizen. So the slab rate benefit given for senior citizen and super senior citizen is only for resident senior citizens only. If they are a non-resident senior citizen, then they will not be entitled for the lower slab or the slab rates applicable for senior citizens. Hope this is clear to all of you. Can we go
One
to the
more
next?
next
Yes,
slide. Yeah, one more exemption, as in that is available under section 87A, where if your income is within 5 lakh limit, then you are not liable to pay any tax in India. So that benefit of 87 section 87A that is available only for non resident, is not available for non-resident. So once your income is exceeding 2,50,000 for a non-resident individual, you are liable to pay tax in India. The exemption of 87A, which is available for resident, is not applicable in case of non-resident. There are few more exemptions which are which a non-resident can't claim. They are 80DD, which is for differently abled person, and 80DDB. Again, if you have made any medical expenditure for dependent person who is disabled, that exemption is also not available for non-resident. 80U, where deduction for disability where taxpayer himself suffer from disability, as defined under the section, is allowed only for resident individual. It is not available for non-resident individuals. So certain exemption which are available for long-term capital gain, that is 80C, 54C, 54, 54F on long-term capital gain. NRI are allowed to claim this such exemption. So one thing is, whenever NRI sells something some property in India, if it is a long-term property, long-term capital gain is applicable. Then they are subjected to 20% straight TDS. So obviously the taxable income may not, as in the total tax may not be 20%, but he can claim as in if he has made investment as specified in section 54, 54 EC and 54 F, then his total tax liability may come down. Then in that case, he has to file his return, claim such exemption, which is available under section 54, 54 EC, 54 EF for long-term capital gain, and then claim a refund of TDS deducted earlier.
Basically, just to make you more clear on this particular point, whenever there is a sale of property by a non-resident, right? So especially a house property or a land in in India, the non-resident has to suffer a TDS of 20%. Whereas provided the value of the property which is sold is exceeding 50 lakhs. Basically, when a person is buying property from a non-resident, he's supposed to deduct TDS at the rate of 1% normally from a resident. But if the same property is bought from a non-resident, then the person who is buying the property from a non-resident should withhold tax at the rate of 20%. But alternatively, there is one more remedy which is available. There is one way where the non-resident can go to our tax authorities and request for loan deduction certificate, telling that don't deduct me at 20%. My effective tax liability is lesser than 20% on the capital gains earned from the property which has been proposed to be sold. He has to furnish certain documents. He has to furnish certain agreements and documents, and along with the forms to claim that lower deduction of tax.
Slide. Any questions?
I hope we have cleared all the questions during the session, Siddharth. I think that's the reason why no questions are here. Anyone who has got questions, you can raise your hand or probably post that in the chat, or you can speak out. That also will be helpful. Okay, great. I think we concluded. I think, ma'am, we can conclude it in case we consider all the points.
Thank you, Siddharth sir and Sridhar sir, for updating the various practical issues involved in NRI taxation. And thank you for your excellent deliberation. And in spite of, classroom education, your interactive session with and by discussing with both of you made the session more lively. Actually, just for information, sir, we have a YouTube channel and with 20,000 plus subscribers. So even though this is office hours, no, after office hours, every program being, even as per previous experience only, every program is viewed by almost 3,000 to 2,000 students. Definitely your session will be definitely helpful for our students. And thank you once again. And thank you all the students for registering this, for joining this program. Thank you. This section is concluded.
Thank you.